Welcome to the special feature on the China bond market. Developments in the China bond market are one of the most interesting developments in the investing world today, and hence very much warrants a deep dive into this topic. The China bond market has grown significantly in the last 2 decades. Having overtaken Japan, it is the second largest bond market today after the United States. A savvy investor today cannot afford to ignore the rapidly rising and evolving China government and corporate bond market. One of the most recent key developments in the China bond market has been the inclusion of onshore China government bonds into international indexes. The Bloomberg Global Aggregate Bond Index commenced inclusion of China onshore bonds from April 2019. The JPM Government Bond Emerging Markets Index started including China onshore bonds from February of 2020. And finally, the FTSE Russell is expected to start including China bonds into the FTSE World Government Bond Index from October of 2021. Cumulatively, the addition to these indexes is expected to attract $300 to $400 billion of flows from passive funds that track these indexes into the onshore China bond market. The most important factor to consider here is that both the China government and the government-linked bonds still offer higher yield in percentage terms compared to most of the developed market government bonds, while still being relatively well rated at A1, A+. With a large portion of the world government bonds now in negative territory, the appeal of Chinese government bonds is expected to only go up. Another factor to consider here is that historically the Chinese bonds have exhibited low correlation against Western markets and hence add a diversification benefit. Historically, foreign investors have not been avid participants in the China bond market. Local investors have dominated this market, and China's commercial banks are the biggest holders of domestic bonds. It is estimated that almost two-thirds of China government and policy bank bonds outstanding are held by the commercial banks in China. Even at the end of 2019, foreign investors were estimated to own less than 3% of the domestic market, with their investments focused on the same government and policy bank bonds that China's commercial banks prefer. This underrepresentation is a legacy of past policies that imposed complicated registration requirements on foreign investors, capped the size of their investments via quotas, and restricted their ability to repatriate profits. That's why most foreign investors stayed away and major international index providers excluded this market as well. With the internationalization of the RMB being a key priority, the China government has taken a number of steps to liberalize investment into the China bond market. Up till 2016, foreign private sector investors who wanted to access this market had to get an approved license. The approval process was lengthy, and the investment quotas and repatriation restrictions made it ever more difficult. Private sector investors now have two more options: a program that confers direct access to the China interbank bond market and the Bond Connect platform. Both offer more convenience in terms of a streamlined approval process, no limits on investments and repatriation of profits, and the ability to hedge foreign exchange risks at the onshore yuan rate. Investor flows through these new route alternatives have been steadily growing in recent years post the liberalization measures. Here's a quick look at some of the retail investment alternatives for the China bond market: the BlackRock China Bond Fund, the iShares China CNY Bond UCITS ETF, and the recently launched ICBC CSOP China Government Bond Index ETF are the three largest investment alternatives in the total bond index and the government-only bond index space. All three ETFs have garnered very significant assets under management and have attractive yields and at the same time provide a useful diversification benefit.